Welcome to topic 5, cash flow statements. And in this topic, we're obviously going to be looking at the statement of cash flows, or sometimes called cash flow statements. We'll start off with looking at why we have them and just how they're generally set up. And then we'll go through the process of actually preparing the statement of cash flows and actually sort of dig into how one of these is created. And in doing so, we'll look at the operating, the investing, and the financing activities sections. So suppose to start off with, why a statement of cash flows? Now what it does is it reports all the impacts of the various operating, investing, and financing activities on a firm's cash flows. Now, there is an important reason why we end up showing this, and it wasn't always mandated, and even prior to being mandated, a lot of companies would provide it. Is that there are many people out there who don't necessarily believe in accounting profits, and whilst there are a lot of good things about accounting numbers and the use of the accrual system, ultimately cash generation is what people need to be focused on. And the cash flow statement helps us unpack some of that. Where it provides additional information over what we already have is that whilst on the balance sheet or the statement of financial position, you can see the change in cash, that those two numbers don't necessarily tell you how much cash is being generated and how much cash is being spent. Which is why we want to look at the cash flow statement. So what we have, and it's a little bit small here, and this is the Woolworths 2017 statement of cash flows, is it shows all the inflows and outflows during the period. And if these were just listed in any particular order, it wouldn't be necessarily all that useful. So what is required is that these cash flows are all categorized into one of three categories: the operating section, the investing section, and the financing section. In terms of preparing this statement, this is where information is collected from a whole variety of sources, and in essence, we're trying to explain how all of the non-cash accounts have changed. And we do that by taking the balances of those non-cash accounts and then looking for additional information from the statement of profit or loss or other information that is provided. And the structure is, we already discussed. We start with the operating activities and whatever the net cash flows are. We add in or potentially subtract cash flows from investing activities. We then add in the effects of cash flows from financing activities to give us an overall change in the cash balance, or overall change in cash from the start of the year. We then add that change to the cash at the beginning of the year to end up with the cash at the end of the year. Now, hopefully, and they should, the cash at the beginning of the year is obviously from the balance sheet, and the cash at the end of the year that's calculated here should match with the closing balance of cash in the balance sheet. So when we turn now to the classification of the cash flows, the operating cash flows are associated mainly with those from revenues and expenses. So it's just the company or the firm doing what it does for business. Providing services to customers, selling goods to customers, paying employees, renting property, all the things that it does, in a general day-to-day business. So, as the name suggests, operating activities. When we look at investing activities, these really focus on the buying and selling of non-current assets and investments. So have they purchased machinery or land? Have they sold or divested machinery or land? Or potentially have they invested in other businesses? The final section, the financing section, really revolves around cash flows associated with debt or equity. So have they borrowed money? Have they repaid money? Have they issued shares? Have they paid dividends, and so on? So now we're going to actually look at these in a little bit more detail. So with operating activities, so operating or cash flows from operating activities. These, as noted, relate to the general day-to-day activities of the business. Now, we don't in this subject talk a lot about the regulations themselves, but the standard that relates to cash flows, AASB 107, permits Australian companies to choose one of two methods to present the cash flows from operating activities. So companies can choose the direct method, or they can choose the indirect or reconciliation method. Now, both methods will yield the same cash flow figure at the end. So the same net figure is obtained. It just goes in they go about it in slightly different ways. Now, whilst companies are permitted to use both, the regulator prefers the use of the direct method. Most investors, when asked, prefer the use of the direct method, and indeed most Australian companies use the direct method. It's something in the order of about 95%. If they choose the direct method, they have to provide an indirect reconciliation in the notes to the accounts. On the other hand, if they choose the indirect method to begin with, they do not need to provide the direct method in the notes. So in a way, they have to do both, or they just do the indirect method. So the operating cash flows, the direct method, what in a nutshell happens here is the company looks at how much cash moves in or out. So it looks at the actual cash flows. And as we can see down here, in this case, they received, or in this case Woolworths, received about $95.5 billion from customers. They provided $61.5 billion to suppliers and employees. They paid interest of $234 million, and they paid income tax of $668 million. So overall, their net cash provided from operating activities was around $3.1 billion. And from this, and again, this is the direct method, we can see the actual kind of amount coming in or out. The indirect method, and it's again a little bit hard to see here, and I would urge you, if you want to look into this in more detail, and you should be, is to go and get the Woolworths 2017 annual report, is that we start with net profit. So I'll zoom in a little bit here. So we start with net profit, and in this case, their profit or loss after income tax expense was $1.59 billion. And what we do then is adjust for a number of non-cash effects. And the adjustments, the main ones that we see are going to be depreciation and amortization. So that gets added back. A whole range of other adjustments take place, including sort of adjustments for any gains or losses. And then we also adjust for changes in current assets or current liabilities. So in this case, there's been changes in inventories, payables, provisions, various receivables, payables, and so on. And we'll look at why that is in a few moments' time when we do this in detail. But what you can see though is that the net cash provided is the same. It's still the 3.122. What the difference is instead of starting from 0 and ending up at 3122, we've started with net profit and then adjusted net profit for non-cash effects to get to 3122. So to calculate the cash flows from the direct method, as already noted, and we'll go through this in a little bit more detail once we look at the example, but we're effectively looking at all the revenues and expenses and then looking at the cash effects of each of those revenues and expenses, because not all revenue is going to be collected. Some may be still as a receivable at the end of the year. Some of the cash collected this year could have been from sales which were made in a previous year. So we're just going to look at the actual cash collected this year. Same thing with expenses. Not every expense is actually going to be paid in cash this year. So an expense which is coming off a prepaid expense, the prepayment may have happened in the previous year. And so the cash movement happened in the previous year, but the expense happens in the current year. So again, we're just looking at the cash movement in this year. Depreciation is obviously ignored, it's non-cash. And we need to not include any gains or losses from the sale of non-current assets because they will be dealt with in the investing section. For the indirect method, as we already touched on, we start with net profit after tax. We adjust for non-cash effects on profits. So we, for example, add back depreciation expense. For gains and losses, we adjust for gains and losses by adding losses from sales and subtracting gains from sales. And then we also need to adjust for the various current assets and current liabilities. So for current liabilities, if they increase, we add them back. If they decrease, we subtract them. For current assets, it's just the reverse. So if there's a decrease in a current asset, we add it. And if there's an increase in a current asset, we subtract it. Now, rather than bouncing back and forward between all of these, I'm just going to go through the details on the slide deck, and then we're going to actually have a look at the example. So we're just going to run through it in its entirety rather than chopping and changing as we go. Investing cash flows, as already noted, primarily relate to the sale or purchase of non-current assets. For example, buying or selling property, plant, and equipment, intangible assets, or financial assets as an investment. So if you're buying shares in other companies, this is not your company issuing shares. This is an extract from Woolworths, and if you cast your eye down the list, what you'll notice is the biggest cash flow by far is the third item, which is payments for property, plant, and equipment of $1.6 billion. Nothing else is comparable to that one. The next three largest and fairly similar sized are the proceeds from sale of property, plant, and equipment of nearly 280 million. If we look at the second one, payments for property, plant, and equipment, 250 million or 253. And if you go about midway down, the proceeds from the sale of subsidiaries and investments was about $200 million. So really, property, plant, and equipment is the main driver in this particular year for Woolworths. To calculate the cash flows from investing activities, we focus on the changes in non-current asset balances. And in general, if there is a non-current asset if a non-current asset balance increases, generally suggests a purchase, not always, but generally does, and therefore a cash outflow. A decrease suggests the opposite. Really important as you go through this, just check what's going on with accumulated depreciation, and also sometimes there could be non-cash consideration. I should pull that back a bit. There could be non-cash consideration or potentially other reasons why there's been a change in the asset balance. Now, in reality, you can have things like impairments, which will decrease the asset balance, which is not a cash effect, but these are not things that we have actually looked at in this particular subject. The final set of cash flows, and this is the final bit before we get into the example, is financing activities. And these cash flows primarily relate to debt or equity. So are you borrowing money? Are you repaying money? Or are you issuing or buying back shares? Now, there's a couple of little things just to be aware of with this, is that dividend payments and interest payments get treated differently. Dividend payments are usually included in cash flows from financing activities, and interest payments are usually included in cash flows from operating activities. And for this subject, that's how we'll treat them. Now, just to be careful, the rules around how these are categorized allow for companies to make other choices. So they don't always have to end up in the activities that we've just identified here. So interest payments could end up in financing. They could end up in investing activities. So just when you're reading the cash flow statement, just be aware of that. In this particular case, dividends paid are included in financing activities. And if we look down the list, the third last and the second last items are, again, by far and away the biggest ones in this case. And for Woolworths, they repaid about $1.4 billion of debt in 2017. The second biggest is the $540 million of dividends paid. And so those are the cash dividends. If they have other sort of things going on with their dividends, if they've got a dividend reinvestment plan, that wouldn't get picked up in that. But we can get a sense that they are shoring up their balance sheet a little bit. And if you then go and have a look at their balance sheet, you would see that the amount of debt on their books has reduced substantially given the amount of repayment that's just happened here. So now that we've gone through what financing cash flows are, how to account for them is in a way pretty similar to what we've just done in the previous two examples, but just focusing on different accounts. So for financing cash flows, we're looking for changes in non-current liabilities and the equity accounts. Also need to be aware of what's going on with dividends. So if there's an increase in a non-current liability or equity, you've generally got a cash inflow. If there's a decrease in either of those accounts or types of accounts, it's generally an outflow. Importantly, make sure you're aware of what's going on with dividends, and you may need to reconcile net profits and the change in retained earnings. Not all movements in non-current liabilities or equity are due to cash. So as already noted, sometimes companies can have dividend reinvestment plans where the dividends aren't actually paid out as cash to shareholders. They're actually, in essence, the shareholders are provided additional shares. So just be aware that that could be going on. And with that covered off, it's time to have a look at the example that goes along with this and to see how we construct all of these things. Okay, so here we have the example that was used, and what we have here is a balance sheet with a number of different asset accounts, liability accounts, equity accounts, and we can see opening and closing balances. So if we have a look at cash, cash has moved from 100,000 to 100,000 to 100. Now, the simplest explanation for that, if we had no other information, is somebody gave them $200. We don't know what, but they've had a $200 net inflow. It is unlikely, though, that that is the only thing which has taken place. And if we cast our eye down all the accounts which are listed there, you can be pretty much assured that that's not the case. In addition to the balance sheet, we also have a range of other information. We have information about property, plant, and equipment being sold, what the net profit was, what dividends were, what income tax was, sales and admin expense, interest expense, cost of goods sold, and the sales that took place. Now that information could be set out differently. You could have it set out as a profit and loss statement, although not everything in that would necessarily be in the profit and loss statement, and there may be other information which we can work out later which would be in the profit and loss statement but is not presented as that additional information. And the aim here is to prepare a statement of cash flows using the direct method for cash flows from operating activities. Now, if we look at this, there are different ways in which we can go about solving this problem. The method that I'm going to use here is what's called the Reconstruction method, and it's used quite heavily in terms of, in universities all around the place, but it's also used by professional bodies and heavily suggested by professional bodies when they have students going through their professional programs to really help them understand and get to grips with how accounts have changed and what the cash effects of them are. Now, I'm not necessarily suggesting that this is how it's done in a practical sense, but it's a really nice way to really bed down the things that we've covered in the last few weeks. The other benefit from it is, as opposed to having to try to remember, a whole range of formula for what happens with different accounts when they increase or decrease, because of the method we'll use, as long as you know your debits and credits, this is a really straightforward way to go about it. It's bulletproof. You're using the same thing each time, and it's just a matter of piecing the information together. So as we go through it, you'll see what I mean with this. So the first thing to do is, and you can do this all in one hit, or you can do this as you go, depends on how comfortable you are with it. But the idea is that I'm going to turn each of these into their various T accounts. So in essence, we'll be looking at the ledger for all the assets, liabilities, and equity. And unfortunately, because of screen real estate, we can't see them all right at the moment. I'm keeping these ones clean for the moment. So cash starts at 100, ends at 100, 200, $100,200. Accounts receivable is a debit balance, 72,230, 106, 860. Inventory, opening, closing. Property, plant, and equipment, opening, closing. Accumulated depreciation, opening, closing. Accounts payable. Long-term debt, contributed capital, retained earnings. If you need to satisfy yourself that those are the same numbers from the example, please do. But all that I've done here is to simply put in all the assets and liabilities and their opening and closing balances. What we then do at this point is to try to explain the changes in some of these accounts and the structure of the cash flow statement. And if I come to this worksheet here, operating activities we start with, we're worried about receipts from customers, payments to suppliers, and you could argue payments to suppliers and employees, etc. So suppliers don't just have to be people that you're buying inventory from. They could be a whole range of different things. So we're basically treating payments to suppliers as what you pay for all your expenses, with the exception of interest and tax, which are lucky enough to get their own separate lines. So we're looking for what we receive from customers, what we pay to suppliers and employees and so on, how much we paid in interest and how much we paid in tax. Okay, so if we start at the top, when we're looking at receipts from customers, what we're interested in is what they collect from sales revenue. So sales revenue, if we had the entry for it, let's have a look at what the information is. Sales revenue was 301,330, and if we were if we were making an assumption that this was on credit, or actually we don't need to make that assumption, it's here. But even if it wasn't stated, it's easiest for our purposes to assume it was all on credit, is 301,330, which would mean you have an entry of debit account receivable 301,330, credit sales 301,330. So we'll put that in. So debit accounts receivable 301,330, credit sales revenue 301,330. And that's coming up that way, 301,330. And that's now dealt with, so I will highlight that, that's gone. Now if we look at these two, this plus this doesn't equal the closing balance. So to make this all work out, we need something on the credit side, and that would represent that they've collected on account, because if you collect on accounts receivable, you would debit cash, credit account receivable. And so the amount that goes here, the difference between the sum of these two and the closing balance, which is known. So that would be debit 266,700 and we credit 266,700. So these two match off. And that's accounts receivable dealt with. So we'll highlight that. The next one we're interested in is payments to suppliers and employees. And moving our way down the list, inventory and purchasing inventory and paying for that inventory is the next cab off the rank. Now, in this case, inventory increases from 90 to 95, so it looks like we've just purchased 5,000 in inventory, but we also know that we've sold inventory. And if we come back to the example, I'll actually strike that out because we've used it. The cost of goods sold was 50,000. So cost of goods sold, if that expense exists, it would be debit 50. Oops, not down there. It would be debit 50,000, credit inventory 50,000, which means the balance at that point is 40, but it's not really, it's 95. So we've had a $55,000 inventory purchase, and so we debit 95 inventory and credit accounts payable 55. That's inventory dealt with and cost of goods sold dealt with. But the amount of inventory that you purchased isn't necessarily the cash flow. That would come down to accounts payable. And in this example, we're also including into accounts payable all your sales and admin expense. That's interest, that's tax. And unfortunately, we have to come across one. It's hiding over here. Your sales and admin expense, and from the information provided, we can strike this one out. Your sales and admin expense was $47,630. So debit $47,630. That's now done. And we have $47,630 because it would be debit the expense, credit the payable. These three combined, we don't know exactly how much they add up to, but they certainly don't add up to 103, which means something has happened on this side, which is a payment of them, which would be the reduction in the liability. So debit account payable and credit cash. And the amount is going to be the three of these combined less the 103,690 is 86,750. And we can highlight that. The last two are fairly straightforward, in this example anyway. Interest and tax, because when we look at the information provided, oops, we can strike that out. When we look at the information provided about tax and interest, income tax expense was paid $5,000, and interest was expensed and paid of $20,000. So income tax $5,000, interest $20,000. So tax $5,000, debit $5,000, tax expense, credit cash $5,000, and interest expense, debit $20,000, credit cash $20,000 because it was paid. That's both of these now done. And we come back to the example and we can strike out that information. So we've used all of this information because it's now in the accounts in the worksheet, and we have used these last piece of additional information down here. When we come back to this, we're starting to build up the movements in cash, and we've dealt with all of these accounts. So I'm going to add these in. So that was the receipt from customers. And we come in here, 266,700, 86,750 is the payment to suppliers, minus 86,750. Interest paid was -20, and tax paid was -5. So we end up with 154,950 as the payment. So not the payment, as the net cash flow from operating activities. And we pretty much follow the same process for investing activities, but now we turn our attention to property, plant, and equipment. And if we look at property, plant, and equipment, we start with 483 and we end with 511, which would indicate on face value that we've had a purchase. However, we know that property, plant, and equipment originally costing $50,040 was sold for $7,150. Carrying value was $6,150. Now, if we have this information, it means we have a disposal, and the amount from the PPE account which is disappearing or being credited is $50,040. So that's the original cost of the asset. So we'll do that first. So we credit $50,040. We actually get told that it was sold for $7,150. So that is the cash inflow. So it would be debit cash $7,150. We're told it was sold the carrying value was 6,150, which means there was a gain of 1,000. So we'll come down to here. So there was a gain of 1,000, which would be on the credit side. But the one thing we haven't done yet is to get rid of accumulated depreciation. And if the carrying value was 6,150 and the PPE disposed of was 50,040 as cost, that means the accumulated depreciation that was alongside it was 43,890. So that is the amount of accumulated depreciation which was on the books of this asset as it was sold. When they sell it for 7,150 in cash, and the gain on sale is $1,000. So we can highlight that because it's done. These aren't done yet though. So when we look at them, that information that we have about PPE is now, that's it. That's all we have. So we strike that out. We come back here. It's all the information we have, and yet this would obviously not lead to this balance. So something else has happened here, and because we have no other information, you have to assume it is a cash movement. And we have equals this minus this plus this. So you have 77,960 in property, plant, and equipment being purchased, because you'd have 483,550 plus 77,960 minus 50,040 gives you a closing balance of 511,470. You can do it in slightly different ways, but that's ultimately the way you end up with those two amounts having to be there. And that has now been dealt with, and that would be debit 77,960, credit 77 I should say 960. And we can add in these two. So there was acquisition for negative 77,960, and the sale for 7,150 is positive. We haven't completed out the accumulated depreciation, and this would help us with the depreciation expense, which for completeness we'll add in. So depreciation is sitting at roughly 124 once you strip out that accumulated depreciation, which is obviously not that. So the difference, or the depreciation expense, is 62,350, 370 I should say. And that's not relevant for here and now, but it may well be relevant in the future. And that's accumulated depreciation. The last ones we're dealing with are now the financing cash flows. So we're looking at the changes in debt, contributed capital, retained earnings. If we come back to the information, this just tells you net profit after tax for the year ended 30th of June 2017 was 117,330. So that tells us nothing about debt or equity. We get told explicit information that there were dividends declared and paid during the year for 71,280. So that would be debit dividends, credit cash. So debit dividends 71,280 and credit cash 71,280. And we might as well, while we're doing it, put it in the cash flow statement. Payment of dividends 71,280. Long-term debt decreases, but there's no other information, which means there is 13,220 debited, which for a liability means it's decreasing, and that would be credit to cash 13,220. And we can highlight that out because we've dealt with it. And 13,220 is repayment of borrowings. And last one is contributed capital goes from 156,870 to 157,430. So it's an increase of 560. So a really small amount, almost a pointlessly small amount, but nonetheless. So credit contributed capital and debit cash. And we add that in. And voila, 154,950, negative 78,10, negative 83,940, net increase of 200, opening 100,000, closing $100,200. We come back here, we just tidy this up because there's a couple of little loose ends and it's always nice to wrap it up. So retained earnings, that dividends would get closed out. So I realize I'm not going to close everything out here. Do we have depreciation expense? I don't think we do. I'm not going to close everything out, but just for completeness of this little bit, if that was closed out, 71,280, that would be knocked into here with retained earnings, and we can highlight that. And the information we have is net profit after tax was 117,330. Oops. And that would be added here, 117,330. And just to double check, and I'll do it over here, equals this plus this minus, so opening retained earnings plus profit less dividends, you can't see it, is 282,310, which is the closing balance. So everything nicely wraps up there. I'll highlight that. Now it's done. And we come over up to here. And if we just want to double check this, I'll just do it down here. So we sum the debits, we sum the credits, and take the difference is $100,200, which is what we have over here. So everything has worked nice and smoothly. And you can see, and hopefully you can see from this method that it may not necessarily be intuitive if debits and credits are something you're still working on, but in terms of just setting it up, as long as you know where the debits and the credits go for the assets, liabilities, and equity, you can just put in the opening and closing balances and they're all set up to go. Then it's just making sure that you know when an expense happens or a revenue happens, you just plug the information in as necessary. And really, you're just looking for what doesn't look right and where the gap is. For mind, it's much easier to identify where a problem exists when you have it visually set up like this, as opposed to looking for just the changes in the accounts, which is a perfectly valid way of doing it. But it's easier to kind of lose your way with it. And we end up with this particular cash flow statement. Now, lastly, just to pick up on the indirect method, and I've sort of set something up already here. So with the indirect method, the relevant things I put in are, these are the current assets and current liabilities, so accounts receivable, inventory, accounts payable, with the various balances, closing, opening, and I've put in also the change. I've also added in what the profit and loss statement would look like. So sales, less cost of goods sold, gives you gross profit. Add in the gain on sale, take away sales and admin expense, depreciation, interest, gives you net profit before tax. Take away tax expense, gives you net profit after tax. So we start with net profit. We then strip out the gain, because that gain has effectively increased, added to sales to get to a net profit after tax. However, that gain, or that's not going to be the cash flow, but the cash flows associated with that gain end up in the investing section. So we need to get rid of this. So we deduct the gain. We then add back the depreciation expense of 62,370. And we add back that depreciation expense because it is a non-cash effect. That depreciation expense has effectively reduced sales to get to profit, but it's not cash, so it can't be treated as a sort of cash expense if that is an actual term. Then we need to make those various adjustments to the current assets and current liabilities. And in this case, I'll just do them quickly, and then we can talk about at least, give an example of at least one as to why we do that. So in this case, each of them has increased. With current assets, if there is an increase, you deduct them. And for current liabilities, if there's an increase, it's just the reverse, so you add it. And we add these all together. And what we get left with is 154,950, which is the same as what we had over here. And so before we wrap up, let's have a look at why this change in accounts receivable is taken away. So if we think about this, accounts receivable has increased from 72,000 to 106. So this 72,000 sitting here, these are people that owed us money at the start of the year. By the end of the year, more people owe us money than what we started with. So that means of these sales that took place, not everyone has paid us back. Not everyone has paid back that money they owe us for making the sale. So we cannot have an amount, if we're adjusting from profit assumes in a way, if we weren't to adjust it, profit assumes that we collected all of this amount, the 301, 330. But we patently haven't, because the amount of people that owed us money has increased. So what we're effectively doing is reducing the sales figure by that amount. That's why you deduct the increase in accounts receivable. And if you think about accounts payable, which is another easy one to sort of focus on, accounts payable is just the reverse. Is if your accounts payable goes up, you've used expenses and you haven't paid for them. So what has been taken away or assumed as expenses, whether it be cost of goods sold or sales and admin or whatever it happens to be, if you weren't to adjust it, you've assumed a net profit that you've paid for all of those things. But if your accounts payable balance has increased, which in this case it has, that means you haven't paid for everything. And so your cash flow, or the amount of cash flow, is actually slightly higher because you haven't paid cash for those. And that's why you add that increase in accounts payable, or indeed any current liability. And so I know that's not going through every single one, and you'll come across situations where you have far more than just sort of 2 or 3 current assets or current liabilities, but that's kind of the underlying logic behind it. And on that note, we will call it a day. So I hope that's helped in understanding how to build cash flow statements using the Reconstruction method, and then also looking at indirect cash flows. But obviously, if you have any questions, please reach out to me.